and welcome to The Debate. Today, we are tackling, well, a really defining debate in modern investment philosophy, Warren Buffett's longstanding and, let's be honest, often blistering critique of gold. This critique basically calls gold the ultimate unproductive asset. However, the environment we're seeing in 2025 has created a powerful test case. I mean, we've seen gold prices surge past, $4,000 per ounce, setting unprecedented records. And this is happening simultaneously with Buffett's own firm, Berkshire Hathaway, accumulating a gigantic record cash reserve. So the central question really is whether this confluence of events, record gold enthusiasm and this record capital flight from equities, does it fundamentally undermine Buffett's core investment philosophy, or does it merely confirm his view that gold is just a speculative magnet driven by market fear? My argument is that this record rally and the current context actually only serve to confirm Buffett's foundational belief. Gold remains an inferior, non-productive asset, and this high price, it's a warning sign, definitely not a validation.
I approach this rather differently. While, the mechanics of his philosophy remain respected, the reality of 2025 marked by Buffett himself becoming a net stock seller and basically signaling that the stock market is overheated, well, it suggests that his traditional definition of unproductive maybe fails to capture gold's essential defensive utility right now. Gold seems to be fulfilling a necessary role, almost like a safety valve, during this period of frankly extreme systemic uncertainty.
Okay, so my position fundamentally is that the principle of intrinsic value, it has to hold, regardless of these short-term price movements. Buffett's philosophy is enduring precisely because gold fundamentally is, well, it's a sterile asset. It generates zero cash flow, requires no management, possesses no underlying growth engine. When Buffett talks about unproductive assets, he means assets that simply cannot compound value on their own. You contrast this with stocks, right, which represent a share in a growing enterprise, or even a basic commodity like oil, which, fuels actual industry. Gold relies entirely on the optimism, or perhaps more accurately today, the fear of the next buyer. The fact that the price has now vaulted over $4,000 per ounce is exactly what Buffett warns against. This kind of wide-scale enthusiasm around a non-producing metal, it's the textbook definition of speculation. It activates the greater fool theory, where value is solely tied to the hope that market sentiment will hold up just long enough for you to exit at a higher price. I mean, historically, just look at the S&P 500's long-term returns compared to gold. It proves his point. This 2025 surge feels like a temporary, maybe even dangerous market phenomenon, driven entirely by sentiment, not sustainable economics.
Right. I see why you emphasize the mechanics of compounding. I really do. But I think focusing purely on that mechanical definition of production, well, it becomes quite limiting when the entire market for supposedly productive assets is, by most metrics, wildly overvalued. And that's the critical shift in 2025. Buffett's own strategic shift kind of validates the need for a defensive posture, doesn't it? His firm has actively retreated from the equity market. Holding a cash pile that large signals pretty clearly that he finds productive investment simply too expensive or too risky right now. So gold's record rally isn't just some random speculation. It feels like a correlated expression of the same collective market anxiety that drives Buffett to hold hundreds of billions in cash. When confidence in the profitability and, crucially, the valuation of traditional companies erodes, the very companies Buffett normally relies on, gold performs its critical function as a non-correlated hedge. In this environment, its very sterility, as you call it, actually becomes its strength, because its value is independent of the overheated equity valuations Buffett himself is currently running from.
Okay, let's address that directly then. I think you might be conflating a highly sensitive price signal with actual intrinsic value. A price of $4,000 an ounce doesn't somehow, transmute the metal into a productive asset. It just amplifies the risk, surely. Buffett never claims to predict price, we know that. But he does predict that over decades, gold will lose the race against any asset that actually compounds value. regardless of whether that race starts at $1,000 or $4,000. So the current price, it just signals peak speculation, perfectly consistent with his long-held warnings about market exuberance.
But the price must be viewed relative to the systemic risk. That's the point. When Buffett, who is, let's face it, the quintessential champion of productive assets, is prioritizing keeping the powder dry with an unprecedented cash holding, well, it confirms that quality, production-based investment opportunities are scarce, at least at acceptable valuations. The market is signaling this through both the gold price and the record cash reserve. You can't really separate those two data points. Gold, or cash for that matter, becomes the necessary alternative when equity markets are deemed too precarious. It fills that defensive, yes, non-productive, but necessary role.
And that leads us perfectly to the core disagreement, doesn't it? The nature of the cash reserve itself. You seem to suggest that holding this gigantic cash reserve in 2025 somehow validates gold as a philosophical alternative, just because both are non-yielding currently. I have to disagree entirely with that premise.
Well, the sheer scale of Berkshire Hathaway's cash reserve, it signals extreme caution about the entire structure of the market, wouldn't you say? And let's be honest, cash also generates very little yield in real, inflation-adjusted terms, especially in the kind of low-rate environment we've seen. So if cash is an acceptable non-productive defensive measure, despite its clear vulnerability to inflation, then gold, which historically has served as a far superior hedge against currency devaluation and geopolitical uncertainty compared to paper currency, well, it has a very credible, tactical, and maybe even philosophical standing during this specific period of market fear. The difference between gold and cash in a crisis of confidence, it can be negligible, and in some key ways, gold might even be superior defensively.
I see your point on the utility of an inflation hedge, but let me offer a different perspective on the cash. Holding cash isn't an acceptance of non-productive assets. I see it as purely tactical and temporary. It maintains absolute optionality. The cash isn't just sitting there as a passive hedge against inflation. It is, as the saying goes, dry gunpowder. It guarantees Buffett can instantaneously act when a productive asset, a wonderful business, becomes available at a cheap price. That is the critical distinction. Cash retains 100% of its optionality for future deployment into productive businesses. Gold, on the other hand, when you buy it at $4,000 an ounce, offers no such option. You are entirely reliant on the sentiment, the whim of the next buyer. Buffett is waiting patiently, perhaps for years, for productive assets to become cheap again. The cash represents future investment in companies, which is his core principle.
So to equate that strategic patience with holding a sterile metal like gold is, I think, to fundamentally misunderstand the difference between waiting for opportunity and relying purely on speculation.
But how long must this patience last? I mean, the size and the duration of this record reserve tell us that this period of extreme caution is pretty substantial. It's clearly not just a 3-month waiting period. And for that prolonged period of market paralysis and high uncertainty, which is exactly when gold tends to perform its function best, cash and gold are arguably fulfilling similar defensive functions against the perceived risk of equity market collapse. Yes, okay, the ultimate intention for the cash is different, to buy businesses, but its present state is one of non-yield defense. And let's also look at the pragmatic risk. Cash, as you correctly point out, offers optionality, but it's also highly susceptible to currency depreciation if global central banks panic, which is arguably a major driver of the $4,000 gold price we're seeing. Gold is a hedge against the potential failure of the very financial system that underwrites the value of that cash. In a low-confidence, high-debt environment like 2025, that defensive utility feels, well, priceless, even if it doesn't compound in the traditional sense.
I'm still not convinced by that line of reasoning, primarily because it seems to ignore the specifics of the 2020 Barrick gold investment. That often comes up when discussing Buffett's stance, right? Critics cite it as proof he somehow softened his philosophy, but I actually think it confirms the opposite. That move was clearly a short-term tactical allocation, focused squarely on the Barrick gold mining business itself. Barrick is an operational entity. It produces profits, generates cash flow, it has tangible assets. It is a productive enterprise, completely unlike holding a gold ingot. And the fact that the position was quickly and decisively exited, well, that further proves it was just a tactical play on market dislocation related to gold producers, not some philosophical acceptance of holding the underlying sterile commodity. It was really an exception that powerfully validated his long-term philosophical commitment to owning compounding enterprises.
Okay, that's a compelling argument regarding the mechanical distinction between the producer and the metal itself. I'll grant you that. But let's look at the strategic implication for a second. Why choose Barrick Gold, of all things, as the vehicle for that short-term tactical move? The timing of that investment, made during a period of massive economic uncertainty and volatility, it shows that assets tied to gold, or maybe even the metal itself, they do enter the tactical calculus when confidence in conventional assets plummets. It demonstrates that in exceptional, uncertain times, and I think we can agree a $4,000 gold price in 2025 qualifies as an exceptional time, that unproductive asset label can be perhaps, needs to be strategically set aside. Even if Buffett preferred the company structure, the reason that company was attractive was surely tied to the surging price and the perceived defensive role of the commodity it produced. To hedge against the downside risk of the productive economy, and gold assets are, well, the standard tool for that.
But that tactical move in 2020, it was a tiny, tiny fraction of Berkshire's total portfolio. And its quick disposal just reinforces the idea that it was an anomaly, tied to sector-specific pricing, not some grand shift in philosophy. The cash reserve of 2025, by stark contrast, is a massive philosophical statement. It says he will wait years, if necessary, for productive assets to become available at the right price. He is willing to sacrifice potential short-term gains from speculation in gold because fundamentally, speculation runs contrary to his principles of long-term wealth generation. Look, if he truly believed gold was a valuable hedge in this environment, logically, he would hold a massive position in it. The fact that he holds a massive position in cash, not gold, shows where his true conviction remains, with the optionality to buy future compounding businesses. This just reinforces the core idea that gold, despite the frenzy, is destined to lag productive assets over the long run, regardless of the temporary market fear pushing it to $4,000.
I think we're fundamentally disagreeing here on whether a long-held philosophy must sometimes bend to immediate market reality. The fundamental distinction remains, I agree, gold does not produce anything, we're on the same page there. But the 2025 price action, I believe, illuminates its critical function as a non-correlated, perhaps necessary defensive asset, specifically when the productive world appears fundamentally overvalued. Buffett's own caution helps define this market as one of extreme risk aversion and a lack of compelling fundamental opportunities. So for the average investor trying to navigate this environment, seeing Buffett retreat into cash and simultaneously seeing gold surge, well, it suggests they probably should prioritize risk mitigation.
The debate here isn't really about whether gold is better than buying, say, Google over 40 years. It's about whether holding gold at $4,000 might be a better defensive position than holding an arguably overvalued S&P 500 right now in 2025. I'd argue the $4,000 price point and the record cash reserve are actually dual signals confirming the urgency of defense, a role which gold, historically, provides quite effectively.
The philosophical distinction for me remains paramount. The 2025 rally, clearly driven by fear and widespread speculation, is a classic market event Buffett has always warned against. His patience and his cash holdings simply confirm his assessment that the market is overheated. But that caution does not, in my view, validate gold as a viable long-term alternative to owning a piece of productive enterprise. It just doesn't.
The complexity facing investors today, doesn't it? While the core definition of value holds, the context of extreme market fear and speculation, which is clearly signaled by both the record gold price and Buffett's own actions. It requires us all to carefully weigh the long-term philosophical rejection of gold against its potential short-term, maybe crucial, tactical defensive role. It does show that in exceptional times, simply defining an asset as unproductive might actually obscure its true strategic utility at that moment.
Indeed. The market environment of 2025, with this strange mix of capital flight paired with speculative exuberance in certain areas, It forces investors to confront where their loyalty really lies, with the mathematical certainty, perhaps, of long-term compounding, or the psychological comfort of a seemingly safer, tangible asset in uncertain times. There is certainly more to explore in the material regarding how patient, principled capital navigates what looks like a genuinely overvalued market.